A decade after the introduction of unconventional monetary policy tools, it is clear that the innovations engineered by central banks in response to the great financial crisis played a key role in the global economic recovery. But from today's standpoint, what does an assessment of these policies tell us about how they worked, their positive and negative effects, expected and unexpected consequences? In two landmark reports, the Bank for International Settlements CGFS and Markets Committee explores the collective central bank experience with unconventional monetary policy tools.
The financial crisis created extraordinary challenges for central banks and required new policy approaches as conventional tools ran out of steam. Many central banks introduced unconventional tools like negative rates and asset purchases, having had limited experience with how they perform in practice.
Well, the committees looked at research, asked central bankers, academics and market practitioners for these complementary reports, which synthesized their views on the collective strengths and weaknesses of the tools.
Central banks that use these tools see them as being effective. They injected liquidity when traditional tools reached their limits. They help soothe market anxiety, and they help stabilise the real economy.
Some policies targeted improved market functioning, and they delivered. Emergency lending programs helped ease funding market strains, and bond market purchases helped cut outsized illiquidity premia. Some tools also had side effects. In bond markets, scarcity of securities created temporary problems. Abundant reserves reduced interbank market trading. A prolonged use of balance sheet tools may have long-term results if they remove market-making capacity or reduce investor participation.
Not everything was perfect. The output response was in the right direction, but inflation has remained below target. There are also spillovers to other economies, as with more conventional policy tools. There are also effects on incentives. Some highly indebted private firms felt less pressure to deleverage, and other policymakers were able to leave the heavy lifting to the central banks.
So central banks now consider these instruments useful additions to their toolbox. So as limits to the effectiveness of conventional monetary policy can recur, the experience of people in the trenches will guide policymakers in the future.
One key lesson is that the tools are most effective when used together with a broader set of policies like fiscal and prudential measures.